Today I want to talk about 3 stocks to consider buying in October 2021. One is a software stock, another is one of the most recognizable brands in the entire world, and the third is a potentially undervalued microcap stock. Now I haven't made one of these buy videos in a very long time, and that's simply because the market has been too expensive for my taste lately, and I couldn't feel right about making a buy now video if I wasn't buying myself. But after a recent drop in the market, we have 3 growth stocks on deck. Let's do it. What is going on, everybody? My name is Matthew, and in today's video we are talking all things Zuora, PLBY Group, and Envela Corporation. I don't want to waste your time, so those are the 3 right there. 2 I'm buying, 1 is an honorable mention, and in this video I'll focus most of it on Zuora, a turnaround tech play, and Envela, a turnaround gold and re-commerce play, because I just recently did an update on PLBY and why I've been buying lately. For each, we'll cover a brief overview / refresher of their business and what they do. We'll also take a look at recent news relating to the company, and finally a little bit of technical analysis when applicable, just for fun. So first is Zuora, and I want to mention right up front a little disclosure. I do own a position in this company, making up about 8% of my portfolio, and I may add some more shares here. I'll explain more on my game plan later in the video. So as a brief overview, Zuora is the company leading and powering the subscription economy. And by that, I mean they are helping power companies like Zoom, IBM, HBO, DocuSign, Chegg, GoPro, and so many more. With the complications and complexities of a subscription business, they help these logos build their customers, recognize revenue, and launch new products. Now, according to recent studies from Ernst & Young, Gartner Research, and IDC, 90% of tech companies are embracing subscription business models. In the future, 75% of all consumer-facing companies will deliver subscription services, again according to this research, and eventually more than 50% of all global GDP will involve subscriptions in one way or another. Zuora already has a strong client base, including 26 of the Fortune 500, 8 of the top 10 auto manufacturers, and some of the most recognizable companies in the world, as you can see by these logos. Lastly, their plan is to land and expand, gain clients by having them sign onto one or more of these 3 services, which they call their beachheads: billing, revenue, and collect. Then form strong relationships with said customers to upsell them on the rest of the Zuora ecosystem. And I want to highlight their TAM, or total addressable market. Today, it's a $5 billion opportunity growing at 25 to 30%, and Zuora has only captured 5% of it. But a huge slice of the market, and this is what's special about it, is custom homegrown solutions by smaller subscription-based companies. This means that they're small companies using things like Excel and Google Sheets to track their subscription revenue. Those businesses will eventually outgrow their current system and seek out services like Zuora. The point is, 36% of their opportunity is essentially greenfield opportunity, also known as an opportunity where Zuora's competitors have not already been. So it's not like Zuora is trying to wrestle for elbow room within their total addressable market. Instead, with so much greenfield opportunity, and if they can execute, I believe they should be able to hit and reach and maintain that 25 to 30% growth rate of their industry. And this brings us to the recent news with Zuora. In their most recent quarter, the biggest highlight for me personally was that their subscription revenue grew 23% year over year. Not only is this closer to that 25% industry growth rate, which I would probably use as sort of a benchmark, but it's also a huge improvement for this business in particular. Now, what I didn't mention in my initial reaction to their Q2 report, because I simply hadn't seen it yet when I was writing the script for that video, was that there was a $1.1 million one-time benefit for subscription revenue, which could have made revenue growth look a little bit better than it really was. And if you guys are going to watch my videos, I have to be able to show you both sides. So what we should do is back that out and see what the normal or adjusted subscription revenue growth really was without that $1.1 million one-time benefit. And by the way, if you're wondering, these are my annotations for their Q2 conference call, which I sent out to everyone in investor community. I'll occasionally edit SEC filings and conference call transcripts and send them out to the Discord, so you can check that out in the link below if you'd like. But let's back it out. So first, we take their $71.5 million in subscription revenue for Q2 and subtract the $1.1 million one-time benefit. and we get $70.4 million. Now, if you see FY22, that means fiscal year 22, which is actually the year 2021. In other words, just treat FY22 as 2021 and FY21 as 2020. So from there, we take that adjusted revenue and we use it to get the actual growth rate by subtracting last year's subscription revenue, which was $58.3 million for the same quarter, according to their quarterly report. And this gives us the actual change in revenue year over year without that $1.1 million one-time benefit. So next we divide by Q2 subscription revenue from last year, which again was $58.3 million, to find that even with the $1.1 million benefit backed out, Zuora grew subscription revenues by over 20% in the past year. And anything over 20% at this point in time, I am quite happy with as an investor. We also saw an upgrade from Morgan Stanley's analyst from underweight to neutral on Zuora, which is great because that particular analyst was quite bearish. He had actually rated it as a sell earlier in the year. And we also saw a new price target of $24 per share from, I believe, Craig Holman was the analyst there. Also from the Q2 conference call, we are reminded that Zuora is actually exposed to the Internet of Things. The CEO Teen Zo is very bullish on the IoT industry, or again, Internet of Things, which is essentially connecting everything, even hardware, automobiles, robots, all of it to the internet. Now, if you use your imagination a bit, you realize that this could spawn countless subscription products and services that would require the help of Zuora. And here's another blurb from their call when Teen compares the revolution of tech companies moving to the SaaS model to manufacturing companies turning into an IoT model. Zuora is positioning themselves to power the Internet of Things by making manufacturing one of their primary customer verticals. Do not sleep on this. Finally, they brought their dollar-based retention rate back from under 100% again earlier in the year to now 108%, which means more clients are spending more with Zuora than there are clients leaving or lowering their spend with Zuora. And they beat their goal to reach 105% dollar-based retention by 2 quarters. They were 2 quarters early. Not to mention, actual churn was down by more than 50% year over year. And as a percentage of ARR, or annual recurring revenue, it's one of the best levels they've seen again in 10 to 12 quarters. That is 3 friggin' years. That means they're once again matching numbers from their glory days of their IPO. So don't let my tone or research or presentation influence you at all. I'm just sharing the facts that I find compelling with Zuora. But you can't tell me this company is not turning around. Now, I've shown Zuora's chart here a couple times on the channel. This is their max chart, which goes all the way back to 2018 when they IPO'd. And you can see that, yes, this is indeed a turnaround play. This is the crash in March of 2020. And I believe we are indeed at an inflection point. And I think that can be kind of seen as well in 2021, where we've really just seen an uptrend for most of this year, which means higher highs and higher lows. Now, right now, we're at one of those lows, trading close to the 200 SMA, which I believe could act as some sort of support. And I don't mind adding somewhere around here for Zuora, to be completely honest with you. My cost basis, I think, is around 16.19 or somewhere around there. So if it drops below my cost basis, I'll probably be adding a few shares. I was going to add some today if it was red. Today it's not. It's up about 2%. But anyway, that's my TA for Zuora. Next up is PLBY Group, formerly known as Playboy, and it goes by the ticker PLBY. I've actually already added to my position on this one twice recently. This is my most recent buy from yesterday at $22.58 per share, bringing my total position to 185 shares at a cost basis of $33.91. Now, I'm not really going to spend much time at all on this one because I've already made a few videos on them, and especially one that was more recent. So I'll link all of my PLBY videos down below in the description so you can go and check them out for yourself. But again, I'll just address how many ways they can actually win as a business and investment. First off would be to renegotiate their poor licensing deals where they're not getting as much as they should, and they could easily probably double or even triple the amount of money that they're getting in some of these licensing contracts, which would unlock lots of potential revenue. Second would be their expansion into India and China. Third would be through mergers and acquisitions such as Lovers, Honey Burdette, and Yandy.com, expanding their presence in the sexual wellness space, utilizing the skills of management that has a lot of experience in private equity, essentially taking companies and making them more valuable. I should probably rephrase, because pretty much any management team would want to make a business more valuable, but what they specialize in is going into a new company, maybe through acquisition, and actually making it better through changing management structure or their business model or the way that the business operates in general to make it leaner, more efficient, and more productive. They take a good business, buy it for a good value, and make it great. Okay, there's also their direct-to-consumer focus, which is kind of a shift in business model, which means they're directly selling to the consumer instead of going through someone else to sell their merchandise for them and collecting royalties. This should improve their margins overall. And of course, in recent news, they announced a new competing platform to OnlyFans called Centerfold. And for context, OnlyFans will likely do $1.2 billion in revenue this year, with about $620 million of it resulting in free cash flow. Just shows how profitable a platform like this could really be. And in other news, I think we can all be adults here. Arguably one of the most popular adult actresses recently just announced that she will be exclusively partnering with Centerfold for her future subscription community, NFTs, and merchandise. Again, check out this video right here for more on the Centerfold announcement. I won't say too much about PLBY's technical analysis because again, not my area of expertise, but I'd love to see it get above that 200 SMA and hopefully break out to the upside out of this area of consolidation. I know one thing's for sure is I'll be going to the Ticker Talk session with Kevin and asking him to analyze PLBY for us and kind of walk through it, and hopefully we can get some community discussion going as well. And this is our, by the way, our community game plan for October for our live mentor sessions. Lastly, ELA or Envela Corporation is an honorable mention for this video. I continue to research this company, but I want to provide an update because I want my videos to serve as a launch pad for all of your research. So again, honorable mention, not quite a stock I'm comfortable buying yet as I continue to do more DD. So I've actually been annotating their 10K, which again, I'm going to be sending to investor community, and I'm probably about 2/3 of the way through this 90-page document. But I thought, since my last video, it would be helpful to go over the holding company structure of Envela Corporation because it honestly was a little bit confusing when I was trying to understand the company. So of course, the head of the company is ELA, that's the holding company, Envela Corporation. And within Envela Corporation are these other businesses, okay? So on the left side, we have DGSE, which stands for Dallas Gold and Silver Exchange. And in 2020, they accounted for $85.6 million of ELA's revenue. Okay, and they specialize in jewelry and precious metals and bullions and re-commerce. So re-commerce is a fancy way of saying reselling or buying and selling of jewelries and precious metals. So on the right side, we have ECHG, and they accounted for $25.2 million of Envela's revenue for 2020, and they specialize in the reselling and recycling of consumer electronics and IT equipment. So DGSC is actually the bigger business segment here with the focus on jewelry, precious metals, and things like that. So within DGSC, or Dallas Gold and Silver Exchange, there are 3 businesses under it. There's Bullion Express, which is primarily an online business, which deals in bullions and metals like gold, platinum, palladium, silver. And there's Charleston Gold and Diamond Exchange, which I believe only has 1 location because of these 2 businesses, there is, I think, 6 locations total, brick and mortar locations. 5 of them are in Texas and 1 is in South Carolina, and Charleston is in South Carolina. So logically, you'd say that they have 1 brick and mortar location in South Carolina, Charleston Gold and Diamond Exchange, and then Dallas Gold and Silver Exchange, which again stands for DGSE, has 5 in Texas. Then moving on to ECHG, which again is consumer electronics and IT equipment. They have 3 business segments under them as well. So there's Echo Environmental Holdings, which specializes in end-of-life electronics recycling. So things like maybe a school has a bunch of 2015 Mac laptops that they want to get rid of. They would go to Echo Environmental Holdings, and they could, take care of it in a environmentally friendly way. There's Teladvance, reseller of IT equipment that sells to or buys from companies. So just imagine them going up to a company and say, hey, we have a bunch of, servers or IT stuff that we want to unload. Okay, we'll buy it from you, and then they sell it to someone else. And then there's ITAD USA Holdings, and they are IT disposal and data sanitization or sanitation. So what that means to me is that we have a bunch of computer junk that we don't want, so we're going to sell it to you. And I think this is actually a really interesting business model where they're able to buy things for cheap because people don't want them. If you are selling your old computer that you don't want at all, you're probably just going to take whatever you can get for it. But they are able to actually extract precious metals, for example, like cobalt, from these electronics and probably sell it for a decent margin. And then data sanitization or sanitation is just making sure that a lot of the data that you're leaving on these devices when you're getting rid of them is securely erased and taken care of. Now, I'm not going to go through all of the annotations here, but one thing I want to note is that they said brick and mortar expansion remains a top priority and strong growth opportunity for DGSE. And so for the key, the red is kind of like worrisome or red flag. Blue is just informational or neutral. Green is good. So I'm not sure brick and mortar expansion is really the best play, but it's hard not to because gold and jewelry is probably a best in-person transaction, right? You're not really going to do that over the phone or online. So it makes sense why brick and mortar expansion is their focus. So with that said, I wanted to try and understand the correlation between ELA and also gold prices, because I wondered how much exposure is this actually to gold and gold prices. So skipping through the risk factors here, I want to take a look at that correlation. Okay, so here we have DGSE, precious metals pricing and business impact. So this is where we can get info on their correlation to gold. So there was a 19% increase in the price of gold during the fiscal year 2019 and a 24% increase during the fiscal year 2020 in the price of gold. And the reason we need to know this is because later it's going to tell us that DGSE crafted precious metals purchases increased 45% in fiscal year 2019. So in 2019, when the price of gold rose 19%, DGSE's crafted precious metals sales grew by 45%. So it doubled by a factor of over 2, or it was multiplied by a factor of over 2. DGSE experienced a dip in crafted precious metal purchases by 21% in 2020, despite gold going up 24% in 2020. So why is that? Well, again, we just talked about brick and mortar, right? It dipped 21% in 2020 despite gold going up 24%, but they're primarily brick and mortar. So lockdown caused this dip, in my opinion, right? You're not going to be able to realize, by a factor of 2, like 40 or 50% growth in their crafted precious metals if you can't have anyone come into your brick and mortar stores. Now, for more on this correlation to gold, it said later in the 10K that revenue related to DGSE's continuing operations increased by 27% during fiscal 2020. So this was a year when they were hit, obviously, by the lockdowns. So an increase by 27% is actually still pretty impressive. And I kind of think that we can't really count 2020 or use it in our assessment as to how closely correlated it is to gold, because it is, again, brick and mortar and lockdowns and everything. But 27% despite a 21% drop in crafted precious metals either tells me one of two things. Either one, crafted precious metals is not a significant portion of their revenue, and therefore any correlations we draw from that information that we just talked about is maybe not good, or it's telling me that there's a significant other revenue streams with the business of DGSE, so it's well diversified and it can withstand a lot of changes in the macro environment. So let me know in the comments below if you like that kind of walkthrough of the 10K with me. Maybe I'll do some more of those. But again, everyone in the investor community, you'll get this document sent to you probably by this weekend. Now, to move on to their valuation. Based on Seeking Alpha's numbers, the ELA actually looks like decent value, trading at a discount to its sector median and a multitude of multiples, including GAAP PE and forward GAAP PE, the PEG ratio, and EV to sales. But we do have some conflicting numbers with Seeking Alpha's forward PE at 11.91 and Finviz's at 9. The forward PE of 9 is what originally caught my eye in this stock, so my guess is Finviz maybe isn't using GAAP earnings, but even Seeking Alpha has non-GAAP forward PE at actually a higher level of 12.66. So this is certainly an area of further diligence for me. And for you. And ELA is also an interesting stock from a technical standpoint as well. This is their daily chart. You can see they're forming a massive triangle, but also struggling to get above their moving averages. So that's not necessarily great, but really tight consolidation here. I'm hoping, obviously, for a breakout to the upside, but with such low volume, it's really, really volatile and susceptible, as you can see, to major moves in either direction. So definitely be aware of the lack of volume. As of now, I do not have a position in ELA. And make sure to check out Hungry Bull if you haven't already. We have over 30,000 weekly active users on the app now, tracking their stocks and getting daily newsletters just like this one. It's a project I'm a part of with Jeremy from Financial Education and Graham Steffen. So that'll be linked down in the description as well. Lots in the description today. We got videos, investor community, Hungry Bull. But yeah, if you enjoyed the video or found any value, and I hope you did, please make sure to hit that like button, subscribe, and check out our quote of the day. You might just learn something. If you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.